Silver has entered a rare timing window. 9 days. One major exchange offline, another holding the pricing wheel. When a global market steps away, price discovery doesn't stop. It shifts. The question isn't whether silver moves, it's who controls the move and what happens when participation returns. There's a delivery deadline approaching, there's a macro calendar ahead, and there's a structural imbalance forming in plain sight. This isn't about panic. It's about positioning inside a temporary vacuum. Because when liquidity thins, volatility doesn't ask permission. Let's map the next 9 days calmly, clearly, step by step. The 9-day window begins. Silver entered an unusual timing window, not because of headlines, but because of structure. For the next several days, participation in global futures trading is temporarily uneven. One major exchange is closed for a scheduled holiday period, while Western markets remain active. Price discovery does not stop when one region pauses. It shifts toward the venues that remain open. That shift does not automatically mean instability, but it does mean the balance of participation changes. In most weeks, silver trades with overlapping global liquidity. Asian hours transition into European sessions, which then roll into North American trading. This overlap allows different pools of capital, hedgers, institutions, speculators, industrial participants, to continuously interact. When one large venue pauses, that overlap narrows. Liquidity becomes more concentrated rather than globally distributed. This is not a dramatic event, it is a structural adjustment. Markets are essentially matching engines. They process orders from buyers and sellers and settle at the price where supply meets demand. The more participants involved, the smoother that process tends to be. When participation temporarily decreases, order flow can have a slightly larger impact relative to total volume. That does not imply manipulation or intent. It simply reflects mechanics. For silver, this window aligns with an important calendar phase, the approach toward a futures delivery notice period. Delivery periods are routine parts of commodity markets. Most contracts are rolled forward or closed before physical settlement. However, as the notice date approaches, traders often reassess positions. Some reduce exposure, others adjust hedges. Liquidity patterns can shift. When holiday timing overlaps with the delivery calendar, it compresses positioning decisions into a shorter active window. That compression is what deserves attention, not alarm, but awareness. Silver's current price level adds another layer of context. After recent volatility, the metal is trading within a range that has seen repeated tests on both the upside and downside. Range environments often reflect indecision. Buyers and sellers are both present, but neither side has full control. In such conditions, liquidity matters even more. If participation narrows temporarily, price can probe the edges of the range more easily. Again, this is not unusual. Markets move through phases of expansion and compression constantly. What makes this period worth examining is the alignment of 3 elements: reduced overlapping participation, proximity to delivery notice, and a macro calendar approaching in the following weeks. The macro backdrop remains steady but sensitive. Inflation data has recently been released, and the next central bank meeting is on the horizon. These events do not directly connect to a short holiday period, but they influence positioning behavior. Traders know that volatility often increases ahead of macro catalysts. When macro timing overlaps with thinner liquidity, price reactions can feel sharper. Sharp, however, does not mean irrational. It often simply reflects fewer offsetting orders at each price level. To understand this better, it helps to break down how silver pricing functions during active global overlap versus concentrated sessions. In full participation periods, large flows can be absorbed more gradually because counterparties are active across time zones. When participation narrows, fewer immediate counterparties may be available. That can result in slightly wider intraday swings. These moves are often reversed once broader liquidity returns. This pattern has historical precedent in many asset classes, not only metals. Equity markets, foreign exchange, and energy futures all show similar behavior during holiday periods or seasonal liquidity drops. The phenomenon is structural, not emotional. Another key factor is sentiment positioning. Silver attracts different categories of participants: industrial hedgers, long-term investors, tactical traders, and short-term speculators. Each group responds differently to timing windows. Industrial participants typically focus on forward needs rather than short-term price noise. Long-term investors are usually less reactive to brief liquidity shifts. Short-term traders, however, may adjust more quickly. If a temporary window creates slightly exaggerated price movement, short-term participants often react first. Longer-term participants may step in only if price approaches levels they consider meaningful. That interplay can produce temporary dislocations within otherwise stable structures. It is also important to separate physical markets from futures markets. Physical supply chains operate continuously, but pricing benchmarks often come from futures exchanges. During a regional holiday, physical activity does not disappear. It simply becomes less represented in real-time futures order flow from that region. Once the exchange reopens, deferred adjustments can occur. That adjustment process is sometimes described as rebalancing. It is rarely dramatic in long-term context, but it can create short-term volatility. None of this implies that silver must move in one direction. Structural imbalance does not predict direction. It increases the probability of range testing. Markets can move upward during thin liquidity. They can move downward, or they can remain contained. The point is not to forecast a specific outcome, but to recognize that participation asymmetry exists. In analytical terms, the next several days represent a microcycle. Microcycles are short structural phases embedded within larger trends. They often resolve quietly. Occasionally, they expand into larger moves if external catalysts align. Watching order flow, volume concentration, and range boundaries becomes more important during such phases. For business owners, investors, and disciplined market participants, the appropriate response is not urgency, but clarity. Thin windows reward patience more than reaction. Overtrading inside compressed liquidity can increase costs without improving outcomes. Silver's broader trend remains determined by macro forces: interest rate expectations, currency behavior, industrial demand, and investor allocation. A 9-day liquidity asymmetry does not override those fundamentals. It only temporarily shifts how price expresses them. When broader participation returns, markets often recalibrate. Sometimes that recalibration is minor. Occasionally it is more noticeable, but it is rarely permanent. The key takeaway from the start of this window is simple. Structure has shifted slightly. Participation is temporarily narrower. A delivery calendar approaches. Macro catalysts are ahead. These elements overlap in time, creating a short period where monitoring matters more than prediction. Markets do not move because of noise alone. They move because of flows interacting with structure. For the next several days, structure is modestly uneven. And in markets, even modest asymmetry deserves careful observation. When participation narrows, volatility changes character. The second phase of this window is not about direction, it is about behavior. When participation narrows in any market, volatility does not necessarily increase in size, it changes in character. That distinction matters. Many observers look only at percentage moves. Experienced participants look at how those moves unfold. In fully active global conditions, silver trades with overlapping liquidity from Asia, Europe, and North America. Orders interact across time zones, creating a layered structure of bids and offers. When one major region pauses, that layered structure becomes thinner. The book is still deep enough for normal trading, but the diversity of flows declines. Fewer independent decision makers are active at the same time. This alters how price reacts to new information. During broad participation, unexpected data often produces an initial spike followed by rapid stabilization. Counterparties emerge quickly. Hedgers balance speculators. Institutions offset retail flows. When participation is narrower, stabilization can take longer. The absence of immediate opposing flow allows price to probe further before equilibrium returns. It is important to frame this carefully. A probe is not a breakdown. A spike is not a trend. Thin participation does not create instability by default. It reduces friction. Reduced friction allows price to test boundaries more easily. Silver currently sits within a technical structure that has seen repeated interaction near range highs and lows. Range-bound markets behave differently from trending markets. In trends, thin liquidity can accelerate continuation. In ranges, thin liquidity often exaggerates false breaks. Traders familiar with this dynamic sometimes refer to these as range extensions rather than breakouts. A range extension occurs when price temporarily pushes beyond a boundary but fails to sustain momentum once broader liquidity returns. The push is real, the continuation is not. This concept becomes relevant during short structural windows. If price approaches a key level during a period of concentrated liquidity, participants should ask whether the move reflects new information or temporary imbalance. Another variable entering this window is positioning concentration. Open interest in futures contracts provides a rough measure of how many outstanding positions exist. While most contracts never go to physical delivery, positioning shifts ahead of notice dates can influence short-term flow. Some traders close positions, others roll forward. The rolling process itself creates additional order flow. When positioning adjustments overlap with reduced global participation, small changes can appear larger on screen. For example, if a cluster of short-term traders reduces exposure simultaneously, price may move faster than it would under broader liquidity. That does not imply structural weakness. It reflects timing. Volatility also behaves differently depending on where price sits relative to moving averages and key technical markers. If silver trades near widely followed levels, thin liquidity can magnify reactions around those points. Algorithmic systems often trigger around predefined thresholds. In narrow participation windows, those triggers can cluster more visibly. Again, clustering is not abnormal. It is part of modern market structure. Another layer to examine is implied volatility in options markets. When traders anticipate potential movement, option pricing adjusts. If implied volatility rises while realized volatility remains moderate, it suggests expectation rather than actual expansion. During temporary liquidity shifts, implied volatility sometimes increases modestly as a precaution. This precautionary adjustment reflects uncertainty about participation rather than conviction about direction. The macro overlay remains present but secondary in this specific window. Recent inflation data has been digested. The next major central bank event lies ahead. Markets often enter short consolidation phases between macro catalysts. Thin participation during such consolidation does not guarantee breakout. It simply increases sensitivity. Silver's dual identity as both industrial input and monetary metal adds complexity. Industrial demand patterns move slowly and rarely respond to week-to-week volatility. Investment demand can be more reactive. When liquidity narrows, it is usually the investment side that drives intraday movement. Industrial hedging typically adjusts over longer horizons. This separation helps explain why short-term volatility often fades when broader participation returns. Industrial flows reintroduce structural steadiness. It is also worth noting that liquidity concentration does not automatically disadvantage any specific region. Western exchanges continue functioning normally. Order books remain active. Large institutions maintain presence. What changes is the global overlap, not the existence of liquidity itself. That distinction reduces the temptation to interpret structural shifts as directional bias. Participants who approach this window analytically tend to focus on confirmation markers rather than assumptions. They monitor volume relative to average levels. They observe whether moves sustain into closing sessions. They watch for follow-through rather than reacting to initial spikes. If a move occurs during thin participation but lacks continuation when liquidity expands, it often signals that imbalance rather than fundamental change drove the move. This window also highlights the importance of time horizons. Short-term traders may find opportunity in temporary extensions. Longer-term investors may find little reason to adjust positioning unless structural levels break with confirmation. Business owners exposed to commodity input costs often hedge gradually rather than react within narrow windows. Understanding time horizon alignment reduces emotional response. There's a tendency in financial media to assign narrative weight to short-lived moves. However, structural analysis emphasizes flow mechanics over headlines. A temporary narrowing of participation is observable and measurable. Its impact depends on how participants behave within it. As this second phase unfolds, the key observation is not whether silver rises or falls on any given day. The key observation is whether price behavior becomes irregular relative to recent norms. Does intraday range expand disproportionately? Does volume concentrate at specific hours? Do range breaks sustain? If the answer remains negative, the window passes quietly. If the answer shifts positive, it signals temporary expansion risk rather than permanent structural change. Markets continuously cycle through compression and expansion. Thin participation is simply one form of compression. Expansion may or may not follow. What distinguishes disciplined participants from reactive ones is their ability to separate temporary structural imbalance from lasting directional signal. Silver's current window is a study in that separation. The next several sessions will not define the long-term trajectory of the metal, but they may offer insight into how liquidity, timing, and positioning interact when global participation narrows. In markets, structure often speaks more clearly than narrative. The re-entry effect. What happens when liquidity returns? If Part 1 defined the window and Part 2 examined how volatility behaves inside it, Part 3 focuses on what often matters most, the moment participation returns. Markets rarely move in straight lines because participation itself is not constant. Liquidity expands and contracts depending on time zones, holidays, macro events, and positioning cycles. When a temporary pause ends and a major exchange reopens, order flow does not simply resume where it left off. It re-enters with adjustments. This re-entry phase can reveal whether the prior movement reflected genuine conviction or temporary imbalance. During a narrowed participation window, price can drift, probe, or compress. But when broader liquidity returns, a new layer of capital reevaluates the current level. Some participants may view the new price as fair and transact normally. Others may see it as stretched relative to fundamentals or hedging needs. That reaction determines whether prior moves stabilize or reverse. This is what can be called the re-entry test. The re-entry test is not dramatic. It is mechanical. Imagine a price that drifted higher during reduced participation. When the previously paused region resumes trading, participants there compare the new price to their internal models, hedging schedules, and inventory exposure. If the price aligns with expectations, activity continues smoothly. If it deviates meaningfully, adjustment flows appear. These adjustment flows can move price quickly, not because something new occurred, but because previously inactive participants are now expressing views. The same applies if price drifted lower during the window. Re-entry can generate buying pressure if participants perceive value relative to forward needs. Industrial users of silver often plan procurement in advance. They are less concerned with short-term volatility and more focused on average cost across quarters. A temporary dip inside a thin window may attract measured accumulation rather than emotional reaction. This illustrates an important distinction. Thin liquidity can exaggerate moves, but re-entry liquidity evaluates them. Another dimension to consider is the interaction between futures positioning and physical demand timing. Futures markets provide a pricing mechanism that reflects expectations. Physical markets operate on delivery schedules and procurement cycles. When a paused futures venue reopens, its participants may respond not only to price changes, but to physical pipeline considerations. If physical conditions remain steady while price has moved noticeably during the window, rebalancing flows may occur. If physical conditions shifted as well, re-entry may reinforce the move rather than counteract it. Therefore, the re-entry effect depends on alignment between price movement and underlying conditions. In addition to industrial flows, institutional asset allocators also reassess exposure when liquidity broadens. Some institutions maintain global trading desks that coordinate across regions. A temporary participation gap may have limited one desk's activity. Upon reopening, portfolio adjustments may take place to maintain target allocations. These adjustments can add to short-term volatility, but they are typically orderly. It is also useful to examine volume concentration patterns around re-entry periods. If price moved meaningfully during thin liquidity, but volume was moderate relative to historical averages, the move may lack structural depth. When broader participation returns, higher volume can either confirm or neutralize it. Confirmation occurs when increased volume sustains the direction. Neutralization occurs when increased volume pushes price back toward prior equilibrium. Experienced participants monitor this shift carefully. They do not assume that thin window movement defines trend. They wait for the re-entry response. There is a behavioral element as well. Traders who operated during the narrow window often carry short-term profit or loss positions. When liquidity expands, some of those participants may reduce exposure. This can amplify the initial reaction to re-entry flows. For example, if price rose during thin liquidity and early traders hold profits, they may sell into renewed volume, contributing to stabilization. Similarly, if price fell and short-term traders hold gains, they may cover positions as broader participation returns. This dynamic can produce a brief burst of volatility around reopening sessions without implying structural shift. Macro context also re-enters the equation at this stage. If major economic data or policy events are imminent, participants may be cautious in expressing large directional views during the re-entry period. In that case, liquidity broadening may compress volatility rather than expand it. Conversely, if macro clarity has improved, re-entry may accelerate alignment toward a prevailing trend. It is important to recognize that re-entry does not automatically reverse prior movement. Sometimes thin window drift aligns with broader sentiment, and renewed liquidity simply deepens it. Other times, renewed participation corrects it. The outcome depends on whether the initial move reflected information or imbalance. Silver's current position within its broader range adds nuance. If price remains near mid-range when participation returns, reactions may be muted. If it approaches a significant boundary, reactions may be stronger as participants defend or challenge that level. One more factor deserves attention: correlation behavior. Silver often interacts with gold, currency indices, and real yield movements. During thin liquidity, correlations may weaken temporarily. When participation broadens, correlations often reassert themselves. Observing whether silver realigns with related markets during re-entry can provide insight into whether its move was isolated or integrated. The re-entry phase, therefore, serves as a diagnostic tool. It helps distinguish temporary structural asymmetry from lasting directional change. For disciplined investors and business operators, the practical implication is patience. Decisions made during compressed participation may lack full information. Observing how price behaves when liquidity normalizes provides stronger signal quality. Markets constantly move through cycles of contraction and expansion. Contraction reduces participation breadth, expansion restores it. Neither phase guarantees a specific outcome. What matters is how price responds as it transitions from one to the other. In this 9-day window, the closing sessions of the pause are only half the story. The reopening sessions are equally important, because in markets, it is not just the move that matters. It is how the market responds when everyone is back at the table. The compression point, when timing, positioning, and liquidity intersect. As the temporary participation window nears its end, the focus shifts from observation to intersection. Markets often experience moments where multiple structural elements align at the same time. These alignment points are not dramatic by design, but they can influence how price behaves in the short term. In silver's case, 3 forces begin to overlap: liquidity, normalization, futures calendar timing, and macro positioning. Individually, none of these elements guarantee a large move. Together, they increase sensitivity. First, liquidity is transitioning from narrow to broader participation. As previously discussed, thin windows can allow price to drift more easily. When broader participation returns, rebalancing flows appear. This alone can create short bursts of volatility. However, the effect is usually temporary unless supported by additional catalysts. Second, the futures delivery calendar approaches its notice phase. Delivery cycles matter less for long-term investors and more for short-term participants who manage contract exposure. As notice dates near, traders who do not intend to make or take delivery typically roll positions forward or close them. Rolling creates mechanical order flow. These flows are predictable in timing but variable in size. When rolling activity overlaps with liquidity normalization, price movements can look amplified, not because of new information, but because multiple flows occur simultaneously. It is similar to traffic merging at a busy intersection. Movement increases not because of panic, but because different streams converge. Third, macro positioning continues to hover in the background. Interest rate expectations, currency fluctuations, and broader risk sentiment influence silver allocation. Even if no new macro data is released during this narrow window, traders adjust expectations based on recent reports and forward guidance. As participation broadens, these macro considerations re-enter price behavior more fully. The intersection of these three forces creates what can be described as a compression point. Compression points are phases where volatility has been relatively contained, but structural tension builds beneath the surface. This tension does not imply imminent breakout. It implies heightened responsiveness. Markets become more reactive to incremental flows. Silver's recent range environment contributes to this dynamic. Repeated tests of upper and lower boundaries create visible reference levels for participants. When structural elements align near such reference levels, reactions can accelerate. However, acceleration is not equivalent to trend confirmation. It simply reflects increased responsiveness around key prices. Another important factor during compression points is leverage management. Short-term traders often operate with tighter risk parameters. When liquidity expands and delivery cycles approach, some participants reduce leverage proactively. This can cause small directional moves that stabilize the market rather than destabilize it. In other words, compression sometimes resolves through controlled de-risking rather than expansion. From an analytical perspective, monitoring confirmation markers becomes more valuable than anticipating outcomes. Confirmation markers include sustained volume increases across sessions, consistency of directional closes, and alignment with correlated assets such as gold and currency indices. Without these confirmations, moves remain tactical rather than structural. It is also helpful to remember that silver's dual demand profile limits extreme short-term distortions. Industrial procurement cycles and investment allocation trends operate on longer timelines. Temporary liquidity shifts rarely override these broader forces. They may adjust price temporarily, but they do not redefine underlying demand. Participants should also be aware of psychological compression. When markets move within tight ranges for several sessions, expectations begin to form. Some anticipate breakout. Others expect continuation of the range. The actual outcome often differs from consensus simply because positioning leans too heavily in one direction. Structural windows like the current one can expose such imbalances, but only if positioning has become concentrated. Therefore, the final stage of this 9-day period is less about prediction and more about evaluation. Has volatility expanded beyond recent norms? Has volume confirmed directional conviction? Has broader liquidity reinforced or neutralized prior movement? These questions matter more than the daily headline price. If liquidity normalization leads to calm absorption of flows, the compression point dissolves quietly. Silver may continue trading within its established range, waiting for larger macro catalysts to define direction. If normalization coincides with strong follow-through and sustained volume, it may signal that the market used the narrow window as preparation rather than distortion. Importantly, neither outcome implies instability. Markets are designed to process imbalances. Temporary asymmetry is a feature of global trading, not a flaw. For disciplined investors and business decision makers, the practical response remains consistent. Align actions with time horizon. Short-term participants may manage exposure around delivery timing and volatility spikes. Longer-term investors may observe without adjustment unless structural levels break with confirmation. Businesses exposed to silver as an input cost often hedge gradually rather than react within compressed windows. As the structural phase concludes, what remains is clarity about process. Silver moved through a period of narrowed participation. It approached a delivery calendar checkpoint. Liquidity broadened again. How price behaves at this intersection reveals more about structure than about sentiment. Markets rarely send clear signals in isolation. They reveal information through interaction between flows, timing, and liquidity. This intersection phase is one of those interactions. And once it passes, silver will return to its broader drivers: macro policy, industrial demand, and allocation trends. The window closes. Participation normalizes. Structure speaks. After the window, separating signal from noise. When a temporary structural window closes, the most important task is not forecasting the next move. It is evaluating what actually changed. Markets often create short periods of heightened attention, but attention alone does not equal transformation. Once liquidity normalizes and delivery timing passes its checkpoint, the question becomes simple. Did the market absorb the imbalance, or did it reveal something deeper? This final stage is less about volatility and more about interpretation. During the narrowed participation phase, price may have drifted, tested boundaries, or remained stable. During re-entry, flows may have accelerated briefly. But once those mechanics settle, silver returns to its broader framework. That framework includes macro expectations, currency dynamics, industrial demand trends, and long-term allocation behavior. The purpose of studying a 9-day structural window is not to assign drama to it. It is to understand how markets behave under temporary asymmetry and how they transition back to equilibrium. Equilibrium in markets does not mean stillness. It means balanced participation. Balanced participation occurs when multiple regions, strategies, and time horizons interact simultaneously. In that environment, price changes tend to reflect collective assessment rather than localized flow concentration. Once this balance is restored, the market's message becomes clearer. If silver stabilizes near its prior range, midpoint after liquidity returns, it suggests that thin window moves were largely mechanical. If it holds near a newly established level with consistent volume and alignment across correlated markets, that suggests broader conviction. The distinction matters. Short-term windows can create what appears to be directional clarity. However, true structural shifts typically show persistence across sessions, confirmation through volume, and reinforcement from related markets. Without those elements, moves remain tactical rather than transformational. Another dimension to consider is positioning reset. Temporary volatility often clears weaker hands. Traders who entered positions with tight time expectations. When those positions are reduced, the market can become structurally cleaner. A cleaner positioning environment often results in steadier price behavior. This positioning reset is not visible in headlines, but it is visible in behavior. If price swings diminish and daily closes become more orderly, it often indicates that speculative excess has been reduced. In that sense, temporary windows sometimes serve a stabilizing function, rather than a destabilizing one. Macro drivers now regain full influence. Interest rate expectations, inflation trajectory, and currency movement typically exert stronger long-term pressure on precious metals than brief liquidity asymmetries. Investors should therefore recenter their analysis around these drivers once the window passes. Silver's industrial demand base also continues quietly in the background. Manufacturing cycles, technology demand, and renewable infrastructure trends operate over quarters and years, not days. These forces rarely react to short liquidity compressions. Their influence becomes visible over longer horizons. It is also useful to revisit risk management after a structural window. Periods of heightened attention can tempt participants to increase exposure based on short-term conviction. Once the mechanics normalize, discipline becomes more important than momentum. Experienced operators often conduct a simple review at the end of such windows. Did volatility expand meaningfully? Did volume confirm sustained direction? Did correlated assets reinforce the move? Did the market close consistently beyond established boundaries? If the majority of answers are negative, the window functioned as a temporary imbalance rather than a structural shift. If several answers are positive and persistent, then further analysis is warranted. The value of this structured approach lies in its neutrality. It removes emotional reaction from the equation. Markets are dynamic systems, and temporary asymmetry is normal within them. Understanding how asymmetry resolves builds long-term clarity. There's also a psychological benefit to this framework. By recognizing that temporary windows exist and close, participants avoid over-interpreting short-term moves. Not every expansion signals a new era. Not every contraction signals danger. Often, markets simply recalibrate. Silver's broader narrative remains shaped by macro policy trends, currency stability, and industrial usage patterns. Those drivers will define the next major phase more than any 9-day period. As the market moves forward, attention shifts back to broader indicators: real yields, dollar behavior, investment inflows, and industrial procurement signals. These metrics provide more durable insight than temporary liquidity gaps. In financial markets, structure governs behavior. When structure changes, even briefly, observation is essential. When structure normalizes, interpretation becomes essential. This concludes the analysis of the window. Participation narrowed, liquidity shifted, delivery timing approached, re-entry occurred, balance returned. What remains now is signal evaluation, and in markets, clarity rarely comes from a single event. It comes from disciplined observation over time. The long view. What this window actually taught. By the time a temporary structural window fully closes, the most valuable outcome is not price movement. It is insight. Markets constantly pass through microphases, compression, expansion, concentration, normalization. Most participants notice the movement. Fewer study the mechanics behind it. This 9-day period offered a clear lesson about how silver behaves when participation temporarily narrows and then broadens again. It demonstrated that markets are not static environments. They are living systems shaped by timing, liquidity, and positioning. The first lesson is that structure often matters more than narrative. During the window, there may have been commentary, speculation, or short-term interpretations attached to price changes, but when examined carefully, the underlying driver was participation asymmetry. A portion of global liquidity paused. The remaining venues carried the price discovery process. That shift did not automatically produce instability. It simply altered the weight of flows. Once participation returned, the system adjusted. This pattern highlights a key principle. Markets respond more to flow dynamics than to isolated headlines. Headlines can influence flow, but flow itself is what moves price. When liquidity narrows, each incremental order has slightly more influence. When liquidity expands, influence disperses. The second lesson is about time horizons. Short-term participants operate inside micro windows. They respond to compressed liquidity and delivery timing. Longer-term participants focus on macro drivers and structural demand. When both groups act simultaneously, price can move quickly. When only one group dominates, moves tend to moderate once balance returns. Understanding which time horizon is active reduces confusion. Inside this window, short-term dynamics carried more visible weight. After normalization, longer-term drivers regained clarity. The third lesson involves confirmation. Many market moves appear significant in isolation. However, true structural change requires persistence. Persistence shows through consecutive sessions, sustained volume, and alignment across related markets. Without these confirmations, price fluctuations remain localized events. If silver moved during the window but failed to sustain momentum after liquidity normalized, it suggests the move was structural imbalance rather than directional shift. If momentum continued with broader participation, it suggests alignment with underlying demand or macro trends. Either outcome provides information. Another important insight relates to delivery cycles. Futures markets operate on predictable calendars. Most delivery periods pass without disruption because the majority of contracts are rolled or settled financially. However, awareness of delivery timing adds context to positioning shifts. Participants managing contract exposure often adjust gradually ahead of notice dates. These adjustments can overlap with other structural shifts, amplifying short-term effects. But once delivery mechanics are complete, the market returns to its broader equilibrium. Silver's identity as both industrial commodity and monetary metal continues to shape its longer-term behavior. Industrial demand evolves steadily, influenced by manufacturing and technological trends. Investment demand fluctuates with macro expectations and risk sentiment. Temporary liquidity windows rarely override these deeper forces. This leads to a broader reflection. Volatility alone does not define opportunity, structure does. Periods of compressed participation reveal how sensitive a market is to flow concentration. If silver absorbed the window with limited disruption, it demonstrates structural depth. If it reacted sharply but stabilized quickly, it demonstrates resilience. If it showed sustained directional follow-through, it suggests alignment with larger forces. Each scenario speaks differently about the market's internal condition. From a disciplined perspective, the correct approach after such a window is recalibration. Participants reassess assumptions. They examine whether key levels held or broke. They review correlation with gold, currency indices, and real yields. They evaluate whether volatility expanded meaningfully or reverted quickly. This recalibration process restores perspective. Markets reward consistency more than urgency. Short-term asymmetry can tempt reactive decisions. However, once the window closes, the broader framework remains intact. Macro policy trends, inflation trajectory, currency strength, and industrial demand growth. These drivers evolve over months and years. The 9-day period did not redefine silver's long-term outlook. It provided a temporary test of liquidity mechanics. Observing how the market handled that test offers more value than predicting each intraday fluctuation. Another subtle but important lesson is psychological. When participants anticipate heightened sensitivity, expectations often exceed outcomes. Sometimes the most disciplined move during structural compression is patience. Not every window produces expansion. Some pass quietly, reinforcing stability. That possibility deserves equal weight. As silver moves beyond this phase, focus naturally shifts to upcoming macro events and broader allocation patterns. Real yields, central bank tone, currency volatility, and industrial procurement cycles will gradually resume center stage. The liquidity imbalance fades into background context. What remains is structural memory. Participants now understand how silver behaved under narrowed participation. That knowledge becomes part of future decision-making. When similar windows arise, whether due to holidays, seasonal liquidity shifts, or calendar compression, the response can be calmer and more analytical. Markets repeat structural patterns even when price levels change. In the end, this period reinforced a simple but powerful principle. Price movement is the visible surface of deeper mechanics. Liquidity, timing, and positioning interact continuously beneath it. Studying those interactions builds discipline. Silver continues forward. Participation is balanced again. Delivery timing has passed its checkpoint. Macro drivers resume primary influence. The window served its purpose, and the market, as it always does, returns to the larger cycle. The discipline phase. What smart operators do next. Once a structural window closes and liquidity normalizes, the market enters what can be called the discipline phase. This is the stage where emotional interpretation fades and systematic thinking returns. The noise declines, the mechanics settle. What remains is evaluation. This phase is often overlooked because it lacks visible drama, yet it is where durable decisions are made. During the previous sessions, silver moved through a period of narrowed participation, delivery alignment, and liquidity transition. Now that participation has broadened again, the correct question is not what just happened, but what does the structure look like now? Disciplined operators begin by reviewing stability. Has daily range contracted back to normal levels? Has volume returned to historical averages? Are closing prices behaving consistently rather than erratically? If volatility reverts and price stabilizes within established boundaries, it signals that the market processed the temporary imbalance without structural damage. If volatility remains elevated with sustained directional movement, it suggests alignment with a broader trend. This is the difference between reaction and transition. Reaction is short-lived and mechanical. Transition is persistent and structural. In this discipline phase, experienced participants avoid overweighting intraday moves. Instead, they analyze closing behavior. Closes matter because they represent consensus after full session participation. A market that repeatedly closes near highs or lows during normalized liquidity reveals more information than one that merely spikes intraday. Another critical element is cross-asset alignment. Silver rarely operates in isolation. Gold, the US dollar index, real yields, and broader risk sentiment all interact with its price. During a thin participation window, correlations can temporarily loosen. After normalization, correlations typically reassert. If silver's behavior aligns with currency movement and interest rate expectations, it suggests macro consistency. If it diverges without confirmation, it suggests localized flow rather than structural change. This correlation check provides context. Risk management also re-enters focus during this phase. Short-term windows can tempt traders to increase exposure, expecting volatility continuation. But disciplined operators reassess leverage after normalization. They ask whether the environment supports expanded risk or requires moderation. Often, after temporary compression or expansion, markets shift into consolidation. Consolidation is not inactivity, it is digestion. It allows positioning to rebalance and new information to integrate. Silver may now enter such a digestion period. Another practical consideration is opportunity cost. Business owners and investors allocate capital across multiple assets. A short structural window in silver does not automatically justify reallocation unless it produces durable structural change. Capital efficiency remains central to disciplined decision-making. Therefore, the discipline phase involves selective engagement. Instead of chasing movement, participants define confirmation criteria. For example, sustained break beyond established range with volume confirmation, multi-session alignment with macro drivers, clear shift in correlation structure. Without these signals, restraint often proves more effective than urgency. This phase also reinforces patience as a strategic tool. Markets are dynamic systems influenced by global capital flows. A 9-day window, while informative, represents a micro-episode within a longer narrative. Long-term trends are shaped by macro policy direction, industrial expansion, and investor allocation cycles. Temporary asymmetry does not override those forces. From a psychological standpoint, discipline prevents recency bias. Recency bias occurs when participants assume the most recent event defines the future. By stepping back and evaluating structure post-normalization, investors avoid anchoring decisions to short-lived conditions. Silver's broader path continues to depend on factors such as inflation trajectory, currency stability, and real interest rates. Those forces evolve gradually. The structural window provided insight into liquidity mechanics, not destiny. Another subtle but important element in this phase is expectation reset. When markets pass through compression without explosive expansion, speculative anticipation often declines. This reset can create a more balanced environment for subsequent moves. Balanced environments tend to produce clearer signals. In practical terms, the discipline phase encourages 3 behaviors. Review data calmly rather than react emotionally. Align decisions with time horizon. Wait for confirmation before adjusting exposure. This approach transforms temporary structural imbalance into educational experience rather than impulsive action. As silver progresses beyond this window, participants should recognize that the market has already demonstrated its ability to process asymmetry, that resilience becomes part of the broader narrative. Markets that absorb imbalance without disorder often retain structural stability. Stability does not eliminate volatility, it contextualizes it. The final insight of this phase is simple. Markets reward consistency of process more than intensity of reaction. Structural windows appear periodically. Those who respond with analysis rather than urgency maintain long-term clarity. Silver moves forward under balanced participation once again. The temporary narrowing is past. The delivery checkpoint is cleared. The liquidity structure has normalized. Now the focus shifts back to fundamentals, macro alignment, and disciplined positioning. Because in the long run, markets do not reward the fastest reaction. They reward the most consistent judgment.